Debt is one of those things that can really hold us back because so much of our extra cash flow will be going to that instead of in our bank account, our investment accounts, or just on something fun that would really add value to our lives. Today's video, I'm going to give you my step-by-step debt payoff strategy. This will help you see exactly when you'll be out of debt, how much interest you'll pay along the way, how much you can save by paying that off sooner. We'll go over why credit card companies or how they keep you in debt pretty much forever based on just their minimum payment strategy, but how you can break the cycle and start using that money to make investments in your future self versus large profits for credit card companies. Going through these steps can literally save you thousands of dollars, not to mention the headache and hassle of just being in debt. So let's get right into it. The first thing you're gonna wanna do is write out all of your debts and the interest rate that you pay for each one next to it. And if you have a difficult time finding this, I definitely understand because credit card companies make it pretty hard for you to just know what you're paying. They're good at hiding this information. So if you just can't see it on your statement, you're not finding it, there is an 800 number somewhere that you can call and talk to a representative and just ask them what interest rate you are paying and how much you owe on that debt. The next thing you'll want to do is subscribe to my channel and help me hit that first 1K because I'm getting pretty close, so I would really appreciate it. And realize that I have loads of other financial videos to help you really level up your money game. Now, let's take that list and use the calculator that I linked below, and you're going to enter each one of your debts into this calculator, and it's going to help you create a debt payoff plan. And I'm about to show you exactly what I'm talking about. Once you get to this calculator, you're going to scroll down here. You can watch a YouTube video on how to do this if you want a deeper tutorial, but come down here. I like to use this Google Sheets version. Get the template. Once you pull that up, you have to click over here and it'll say use template. So do that, and then you can actually enter your information. They have really generic information here. I'm going to keep it there just for the example. You've got your credit card providers or your different loans, balances, interest rates, and payments. So the minimum payments here is $270. So just so I can show you what it looks like to make the minimum payment, we're going to do that and just enter like $1 just to show you what this looks like, just keeping the minimum payment. So we're going to scroll down here. So this is going to be all of your information up on the top. Then you scroll down and you're going to see how much interest you'll pay. So this person paid $39,000 in interest, and it would take them 20 years to pay off this debt balance. Also, make sure you change the date here. So as of this video, I'm making this, I think it's the 28th. I'm not sure. So enter the date that it is so that these numbers are accurate. But when you scroll down, it shows you when you'll be out of debt. And this person included their student loan, so that maybe won't be something you include, but I would at least start with it so you can see and then decide after you work on the interest rates that we talk about how much or which ones you want to include in here. So this is the base. If you do nothing, you make no changes, you just make the minimum payments that you're already making, this shows how long you'll be in debt and how much interest you'll pay. Next, I want you to write out all of your bills and expenses. Try to get as close as you can to what you actually spend in a month. And if you need help with that, take a look at this video because I do walk you through some things to consider when you're doing that. And what we're trying to do with this step is really try to figure out how much money do you have? How much are you working with after all of your expenses and your bills are paid? The extra can then, of course, go to accelerating your debt payoff plan if you have that first $500 or $1,000 saved up, because that is going to be the actual first thing that you need to do before you focus on paying off your debt. Because if you don't have a little chunk of money set aside, you will never be able to, or most likely not be able to, break that cycle of debt, because if something comes up and you have no cash for it, you're just going to put it on a credit card. So make sure you do have that chunk of money set aside before you focus on tackling your debt. Now let's look at what that extra looks like when we enter it into the calculator. All right, so just as a reminder, if you just made the minimums, you'd pay $39,621 in interest. Now, if you're able to carve out, say, $200 extra, so instead of paying $271, you're going to pay $471. Oops, $471. And I'm not the best with this calculator. I know the lines are, you're supposed to put something here, but sometimes it gets glitchy. So I just like to put the payment there. But anyway, we see that it went from like $39,000 now down to $9,000. So you just saved yourself $30,000 by paying $200 extra per month. And instead of it taking 20 years, it takes 6 years. So that's a pretty drastic difference. And that's why I want you to come in here and run your numbers, because it might not be a huge amount that you have to pay to make a really big difference. Okay, one more thing. This strategy shows the avalanche method. That's what we just entered. That's personally what I like to do because it pays the highest interest first. But I'm sure you've all heard about the snowball method, and some people like to use that instead. So you can click that and see how the interest changes over here. So it went from paying $9,000 to paying $11,000. But the difference would be that you would pay off your cards quicker, so you'd have less cards, but the debt value would stay higher for longer. So that's why I personally like the avalanche over the snowball method, but you can just punch the numbers in and see which one makes the most sense for you. Now, if you have nothing left at the end of the month after all your expenses are paid, then you have a couple of things to consider. One, you just have to accept your current debt payment plan, how long it's going to take you, and just focus on being consistent, making those payments over time, and know that you will eventually get out of debt. So just at least you'll have the end in sight. I would mark that down somewhere and try really hard not to get further in debt so that does not change. If, however, you really do want to get out of debt sooner and you look at your expenses, you then can see, where can I make some changes? Where can I make some cuts? You can either decrease what you're spending, or you can work on increasing your income. For this, you're really going to have to tap into the why you want to be debt free, why you want to have these debts paid off, because it will help you not feel deprived, but feel empowered and strong instead as you're paying off your debts. You might have to get a second job, a roommate, sell your car, move, make drastic life changes, but remind yourself that it is temporary. It's such a temporary sacrifice, and really you're just empowering yourself and your future self to not be constantly struggling. So remember, it's temporary. This too will pass. And that'll really help you stay focused. Once you do decide on an amount that you're gonna commit to paying off your debt, I really encourage you to do that immediately when that paycheck hits your bank account, so that you're not tempted to spend it on anything else. That should be the amount that you've dedicated to go towards your debt. So as soon as it hits there, you can pay a portion of your debt off right then and there. Next, I want you to look at your credit score. If you have a score over 700, then you probably can qualify for refinancing, doing some balance transfers, lowering your interest rate in the meantime while you are trying to pay it down quickly. Be careful, of course, with those, because at the end of the terms, your interest rate can really spike drastically. So make sure if you do a transfer or something like that, you are able to pay it off before the end of the term. Now, I want you to ask yourself, are you somebody that really 100% wants to be completely debt-free? I know there is the whole debt-free community and debt-free lifestyle, and that is great, but there is the other side of it. I read this book called The Value of Debt, and through that book, I learned how CFOs manage the balance sheet, and they are responsible for responsibly managing debt and using it as leverage to grow and scale the company. And how we as individuals can do that same thing with our personal financial life. So for myself, when I was going through paying down my debts, I refinanced everything and got all my rates as low as I could and decided to pay off everything that's over 4%, just pay it all down. And things that were under 4%, I saved enough to pay those off. So I did have the option but then I decided to invest that money instead. And if you want to see the actual numbers, take a look at this video because I do walk you through my decision to do that when I ran the numbers compared to investing, compared to paying it off, and just a little bit of behind the scenes of why I decided to do that. But for me and for us, that just works. And I feel really good about it because I feel like I'm using leverage, I'm able to invest, I'm able to have some cash flow flexibility. So even things like our car and our house, we have really good credit, so our rates are right around 2%. So I think my student loan rate is 2.8, but our house is 1.99, our car is 2%. So when you have really low rates, to me, it makes sense to invest the money instead of pouring it all into your car or your home. But it is a very personal decision. So if it weighs on you and makes you feel terrible, do not keep your debt, just pay it off. But if you're like, okay, I can see the value in that, then it is something that you can consider. So with this, if you do decide to keep some of your lower interest debt, then in the calculator, just punch in your high interest debt, the debts that are 10, 15, 20%, or even 8%. Any of those are the ones that you can get laser focused on and really try to get paid off. Then of course you can revisit your lower interest rate debt as well, but that'll at least give you a starting point. One of the things you really want to avoid doing is ignoring your debt or even just paying the minimum payments, because that can just take a big toll on your net worth in the long term. It can really prevent you from investing, and that's just taking away that opportunity for your money to earn money for you instead of a credit card company, because that's exactly what they're doing. They lent you money and now they're just taking their interest from you. And why pay that to them when that can just go into your investment account? It can go towards your lifestyle. Now, lastly, I want to show you this investment calculator. I'll also link it below. But once you do have that debt paid down, you can put these numbers into your investment calculator and see how that adds up over time, and use this to really fuel your fire of getting that debt paid down quickly, because then you could see that money will start going to you where it belongs. Now, just using the same numbers that we were using on the debt payoff plan, instead of paying $471, let's say you decided that you could pay that. We're going to enter, we'll say you start with $100 and now you're able to contribute $471 because it's not going towards your debt every month. It's actually going towards your investments. So make sure this says monthly, and you can change the interest rate. The annual stock market has returned an average of 10% per year. We're going to say 7% to account for inflation, and just over 10 years time of investing, instead of paying it towards your debt, you would have $81,000 saved up. So I really like to see this because to me, that's motivating. All this money, remember the calculator showed us taking 20 years to pay off the debt. Instead, it went down to, I think, 6 years. So you would have all this money that's added to your value instead of the credit card companies. So punch these numbers in and see what it looks like for you. And of course, you could change this number to 20 years. Now you have $245,000 20 years from now. And it could seem like forever, but if you don't take steps to doing this, then you might just never start investing because you're just making the minimum payments and skirting by throughout your whole entire life instead of taking some action and getting into this. I really like to use that investment calculator to motivate myself when I was getting my debt paid down. And even now, my husband and I have been investing for over 5 years, and it's still pretty exciting to enter those numbers and see what our future holds and how much that compounding really does add value over the years to our finances, which then encourages us to keep saving, keep investing, and focusing on building that net worth for our future selves and our children and our family and friends and all of the causes that we care about and all of that. So that's really why I encourage you and help you pay off this debt, because then you can get to the more exciting, fun, rewarding parts of life. And that's all I really have for today. So let me know in the comments below if you have any questions. Don't forget to subscribe if you're new here. I would really appreciate that. And I will see you on the next one. Bye.